So with this, I'd like to start inviting our next speaker up here, talking to us about evaluation of gold from 1997 till 2023, talking about specifically about risk-adjusted return portfolio diversification and inflation protection, is Dr. Renisha Chainani, Head of Research, Augmont-Gold For All. She's been heading research at Augmont for the last few years and is also a certified independent director. In 2022, let me tell you that she became the first lady to earn a PhD in gold in India. So that is truly a unique feather in her cap. She's also been a prominent guest speaker on business news channels across panel discussions like CNBC, Awaaz, etc. And in March 2023, she was honored with the Golden Girl title at IBJA. Everyone, let's make some noise for Dr. Renisha Chainani as she takes over the podium.
So good evening, everyone. It's always a great pleasure to come to such conference and talk on various topics and meet everyone in person. So today my topic is regarding the risk-adjusted returns on gold and whether if you diversify your portfolio into gold, how does it outperform? So we have seen that India's gold-related policies and rules have evolved over the years since independence. And today there is a shift towards more streamlined and transparent approach. But it was not so if you look at 75 years back. It all started with a restriction phase in 1947. And during this period, the policy were aimed at regulating the supply of gold and domestic gold prices, and also reduce the smuggling. So the Foreign Exchange Regulation Act came up. Then in 1962, we had the prohibition phase, where a government imposed few restrictions on production and transaction of gold. And this led to Gold Control Act. Then the third phase, it started in 1990, it was the liberalization phase, where government began to deregulate the gold industry. And this was very, very important phase for the bullion industry. And the most important year was 1997, when banks were authorized to import gold into the country. And we all know that this was through OGL, Open General License. So after 97, it has been a tremendous development in bullion industry. Let's look at what happened. Most of us know it, but I'll just like to repeat few of the developments. So after 97, gold deposit schemes were introduced. Banks were again permitted to sell coins. GDS was introduced. ETFs came up. MCX came up. GMS came up. SGB was launched. 80-20 rule was there. And then import duty hikes were there. And then finally, a revamped GMS was introduced and hallmarking was introduced. So there were various phases. Till 2012, it was liberalization phase, and 2012 and 13 was the intervention phase. And after 2014, it has been the transparency phase. So this is the list of domestic historical events and policies that have happened in last 25 years since 1997. These events have impacted gold prices domestically, which I will evaluate now. But we also need to study what has happened internationally in last 25 years. So the topic was from 97. So this is the reason I showed you what has happened in 97 and why we are evaluating last 25 years. So let's see what happened internationally in last 25 years. So let's see how gold performs in all these scenarios. And it is often said that gold tends to perform well in the period of economic uncertainty such as recession and stagflation due to status of its store of value, and it's often said as hedge against inflation. So these are the various scenarios which we'll look at how gold has performed in the last 25 years. So whether it is a loose monetary policy or a tight monetary policy or it is a sell-off in other classes. So what happens in gold? So first scenario is what happens when there is loose monetary policy in US. So there has been various interest rate cuts in last 25 years. There have been 3 instances, and there has been quantitative easing also. In all such instances, you can see gold has outperformed, giving 40 to 50% return. Next scenario is during the time of geopolitical tensions or natural calamities. During those times also, we have seen like 9/11 attack or US-China trade war, or whether it was pandemic, gold has performed around 20 to 30%. So it has given positive return during this scenario also. During the times of financial crisis, here too we have seen gold has been outperformer. US subprime crisis, Great Recession, Brexit, all the times gold has performed well, giving around 40 to 50% return. Next scenario is when there is sell-off in asset classes, other asset classes like in oil, in equity or crypto. What happens to gold? It is generally noticed that we see somewhat sell-off coming into gold as there is, margin call pressure or a spillover effect that comes. So gold underperforms during this scenario. Then there is a scenario of tight monetary policy where interest rates rise. So this has happened in 3 times in last 25 years when interest rates have risen continuously for a period of time and gold has underperformed in these scenarios. So I showed you 6 scenarios and the last one is inflation. What happens when there is high inflation? So whenever there is high inflation, more than 5%, gold prices have outperformed and given more than 25% return per annum. If the inflation is more than 3%, gold has returned more than 15%. And if the inflation is less than 3%, we have seen 5 to 6% returns. So these are the various 6 scenarios that, I have evaluated how gold has performed internationally. So we looked at domestic events, we looked at the international events, what has happened in last 25 years since 1997 in gold. But as we are talking about the portfolio diversification, we need to look at what has happened in other asset classes rather than gold. So the CAGR return of different asset classes, as you can see here, let's compare that. So Indian equities, global equities and gold has fetched somewhat same CAGR return of 11 to 13% in different time frames. You can see 3 years, 5 years, 10 years, 20 years, 25 years. So all those time frames, their return is mostly around 11 to 13%. Bonds, Indian bonds and silver, their return is somewhat hovering around 7 to 8% in different time frames. Commodities are high risk and high return asset class. So in last 1 year, we saw that commodities outperform, it gave 30% return. But if you look at the CAGR return of last, long term 20, 25 years, the return is minimal, and in last 10 years, return is just 0%. So it depends which asset class you are investing in. So we saw the return. Now we also need to see volatility. Volatility is important because we need to check whether the risk which we are putting into our investment, whether it is giving us that much return or not. And most of us, what we do is, we tend to exit our position when investments, we see a sharp fall in the prices. So looking at volatility is very important, and as you can see, gold's annual volatility is something around 15 to 18%. Silver volatility is highest, around 28 to 35%. So this is the volatility of different asset classes. Now we know what is the return of different asset class and what is the volatility. Let's discuss risk-adjusted return. So what is risk-adjusted return? It is the measurement of how well an asset performs based on the risk incurred by the investor. So I have calculated RAR, that is risk-adjusted return, using Sharpe ratio, which is a comprehensive mechanism used worldwide to ascertain the performance of the fund against a given level of risk. So for simple understanding, I have put 4 asset classes in a portfolio, which a normal Indian investor would do. They will generally invest in Indian stocks, global stocks, somewhat money in bond and somewhat money in gold. So here is various permutation and combination used for a hypothetical portfolio if some money is allotted to equities, bonds and gold. So how much RAR we are getting? Okay, the first portfolio, hypothetical portfolio has 80% in stocks, 20% in gold. Similarly, various combinations are tried with lesser allocation to equities and more to gold. So what we can see from here is, so I have listed out 20 such hypothetical portfolio examples here. As you can see, the 20-year RAR return in a portfolio where there is 0 allocation to gold, you can see here the last 2 lines highlighted, the RAR is In 20 years, it is 31%, and for 25 years, it is 21%. And if you look back, the first one, where more allocation is done to gold, we see the RAR is 47% and 37%. So your risk-adjusted return rises when you do some allocation of your portfolio to gold. And 20% gives you more return. I'll come to prove that why 20% and why not 10% and 15%. So this slide gives you the return, volatility and RAR, which is compared of a portfolio with gold and without gold. The thing which is highlighted, this is risk-adjusted return. How much return do you get if you have gold in your portfolio and if you don't have gold in your portfolio? So certainly, if you can see that with gold, the portfolio return is higher. Okay, so we saw the return, we saw the volatility, we saw the risk-adjusted return. Let's see what is the correlation of gold with other asset classes. As you can see, gold has very minimal correlation with equities and bonds in different time frames. I have listed 10-year, 5-year, 20 years, 25 years. So maximum correlation we have seen is 0.3, right? And there have been various instances where stocks have performed well, gold has not performed. So like in 2013 to 16, where we saw that stocks were performing very well, but gold did not perform during that time. Then there was period of 2000 to 2003, where Indian stocks did not perform well, but bonds did well. And there was period of 2008 to 13 when gold did well, but stocks didn't perform. So there are various phases in investment where some asset class does well, other does not. So diversifying it would give you higher returns. So the rule is you should divide your asset class across various asset classes to rule for lasting longer. Okay, this is a simple graph that shows you what is the risk-adjusted return of a portfolio in various time frames with gold and without gold. As you can see, the red line, it shows you the risk-adjusted return with gold. It is certainly higher than without gold. So why I was saying why 20%? I have compared here the risk-adjusted return of portfolio in all time frames. And as I compared, I can see, we can see that if you have 0% gold in your portfolio, then your risk-adjusted return is something around, 25 to 30%. But you invest more in gold, if it is almost 20%, then your risk-adjusted return rises. So it is always said to invest at least 15 to 20% of your portfolio in gold, your RAR will increase. So what is the conclusion out of this is, one, I showed you different scenarios. So gold performs very well and very good. It gives very high returns during the three scenarios. First, that is financial crisis. Second, when there is higher inflation. And third, when there is loose monetary policy by Fed. This is the first conclusion. Second is that gold has very minimal correlation with equities and bonds. And third is that a hypothetical portfolio with at least 20% allocation of gold would give you very good risk-adjusted returns. And the last one is you should divide to rule. Divide your asset, divide across asset classes to rule for a longer period of time. So this is it from my side.
Well, thank you. And we do have a minute or so left. Do we have any question for Ms. Chainani?
Thank you, Dr. Chainani, for this wonderful presentation. I just have wanted a little clarification on whether the returns that have been taken are the physical market returns, as in the physical gold, whose different prices at different time periods have been taken, or have you also considered instruments like ETFs or let's say futures, where you have concepts like excess returns and all, in which case the numbers would be, or the outcomes would be probably different from what the outcomes would be if you are taking only the physical gold returns.
So here I have considered gold returns, which is the LBMA spot price of gold in Indian rupees. So as we are talking about more of Indian gold, I did not consider the international gold returns. This is all Indian returns, Indian gold returns, and it is LBMA spot prices.
Would my question was therefore, I mean, that is what we guessed, but would the outcomes be different if you want to take ETFs or futures? Because there you have other returns
For
also coming in.
futures, I think
Collaterals.
for futures, I suppose the returns would be similar. But for ETF, yes, we need to consider the cost that is involved. So for ETFs, the returns might differ. But for futures and spot gold, I think the returns would be very, very much similar. If you consider, if I would have taken MCX prices, then too the returns are similar.
We have one more. Okay. Let that be the final question of this session, please.
Thank you, Renisha, for this beautiful presentation. I just have a comment. So when you're discussing about scenarios, some of the scenarios are overlapping, I guess, because, the impact of those scenarios are different. Like when we have monetary policy or driven by economic crisis,
True.
the impact is going to be different. While when we have, geopolitical crisis, it will have, fleeting impact.
True.
Just a month or so. So some of the scenarios, we can combine and see the impact. What's the return gold is giving. So that's all my comment is. And I was just going through this, your return part. Maybe if you could define the period, which period you have taken, then it would be, helpful for us. Which all period we can see, because there were different economic events during that period, and that decides the returns for gold.
Yeah, very well said. I would say that yes, I have already defined the periods, and there are various multiple ways that we can take the scenarios. As I've taken scenario wise, I have taken it economic scenario wise, whether it is monetary policy or recession. You can take it in some other form. So scenario analysis could be it can take any other form also. And I have already defined the period, like recession in 2008. I have given the year-wise scenarios. So I have defined the periods. Yes, everywhere I have defined the periods. So whatever is there, it is there with periods. So
All right.
as you can see here, I can just show it to you. So when we were talking about sell-off in other asset classes, so I've given that 2000 dot-com burst, 2006 market crash, right? So only the days and months that is not given, how many days it lasted or all, but the period is there.
And then
Yeah.
for the
So
next slide,
this is-
if you go for risk-adjusted returns,
Yeah,
where you were talking about the Sharpe ratio.
yeah. So this is the Sharpe ratio. Here also I've defined the period.
Is this the latest period? Like if you are considering 1 year, so I should consider 2022?
2022, yes.
Okay, got
It is
it.
from
Yeah.
97 to 2022, so it's been 25 years.
Okay, got
Okay.
it.
So what you've seen is actually literally a timeline being established there. So with this, we conclude this session.